thought-provoking panel discussion on the outlook for capital markets in the current year 2025. Our esteemed panelists, each a stalwart in the investment world, will share their expert perspectives, offering deep insights into the road ahead.
It's a privilege to welcome our first panelist, Shri Manoj Baheti, founder of Carnelian Investment Advisor LLP. Before establishing Carnelian, he held a thematic and mid-cap research at Edelweiss Securities and pioneered analysis beyond consensus, a groundbreaking forensic research approach. So please have a seat.
Thank you.
Our second panelist, Shri Sachin Shah, Executive Director and Fund Manager, MK Investment Manager. Sachin is a visionary behind Equal Risk, ML's proprietary evaluation model that provides an objective lens into corporate structures. Thank you.
The risk comes not from knowing but what you are doing, says Warren Buffett.
I would like request Anand Dama to come up on stage and please moderate this session for us and have a delightful session and have a great journey of capital market.
Is that whether there is a risk on or a risk off trade. What does it means is basically whether you should take the kind of risk that you were taking last year where you're just buying any stocks based on WhatsApp tips and you thought that everything is just going to go up and you just bought, you made money and you thought that this is going to happen this year. Maybe not. This is not going to happen this year, and that's where you need the advice of the experts, and that's the reason we have this panel session to tell you on broader macro outlook what's going to happen and how things are going to shape up and which are sectors where you have to invest. Hello? Yeah, where you have to invest. So this is what is also going to happen with the market, where basically the way Mike operated, that sometime basically market will just switch it off itself, and then we'll think whether we should be there in the markets or we should basically simply move out of the markets, look for FDs or basically for debt investments as such. First of all, we are glad to have Shri Manoj Baheti from Carnelian and Sachin Shah from MK Investment Managers on the panel to discuss the topic. At the outset, let me put the format of this session. So we will first have a panel discussion followed by an opportunity for the audience to ask questions to the esteemed panel. So let me first begin with the first question to both panelists, where I would request Manoj Bhai to first respond to that question and followed by that Sachin Bhai. Past few years have been remarkable journey for the global markets and India as well. We have seen one of the longest running bull markets in the history. However, CY 2025 has already begun with major global events, including induction of Mr. Trump in US, called a disruptive policies that he been adopting, end of Israel-Gaza hostilities, but begin of another war, which is called trade war. Unveiling of DeepSeek, leading to a sharp correction in news age stocks as well as domestic events, including budget, first repo rate cut by new governor just yesterday. How do you see the Indian market shaping up in CY 2025 and beyond? Are we still in the long-term bull market, or should investors brace for frequent corrections before we formally enter into a long bear market? So what is your view for CY 2025 and beyond? Over to you, Manoj sir.
Hello. Yeah. So first of all, thank you, Anand, for having me here, and good morning, everyone. And it's pleasure to be a speaker at this event. So let me first start. I think Anand has said that last 2-3 years post-COVID particularly has been fantastic for equity market investors. In fact, last, I would say 1.5 years, there was an inverse relationship between the amount of research and the returns which you are earning in the market. The lesser is the research, the higher will be your returns. Like you just follow some tips, buy stocks. But this equity market is not about just seeing your returns, it is about retaining your returns, taking home those returns. And if you need to take home those returns, if you need to pass on those returns to your next generation, then hardcore research, there is no substitute to that. So let me, and this year will be a year where this inverse relationship, in fact, many of that has reversed. And this year will be a year when hardcore research will be rewarded. And definitely this year will be a year with lot of uncertainties. Lot of uncertainties means, like if I see geopolitical issues, there will be unpredictable geopolitical issues. With global power changing, there will be unpredictable moves, either on tariff side or on geopolitical side. And each and every announcement will create immense amount of volatility in the market. So it is very, very important to understand that how do we place ourselves within this volatility. In fact, for me personally, these are the best time to invest and create portfolio. In fact, over a period of last 7 years of Carnelian journey, we have made good amount of money in a volatile year, because money is made when you do invest. Money is not like when your investment goes up, if you can capture good investment opportunity. Like, just to give you one example, in October 2020, when entire world was grappling with pessimism, and at Carnelian we have clearly seen two opportunities. One is on the manufacturing in India, and secondly on the technology shift across the world. And we have launched a specific fund capturing these two opportunities, which we call as a shift opportunity. Like, the globally, if the shift is going to happen from the China as well as across the world to India on the manufacturing side, and as well as there will be an acceleration in the technology spend. If these two things are going to happen, how it is going to benefit India as an economy, how Indian companies are going to benefit. Within manufacturing, what will be the clear winners? So we did almost 3, 4, 5 months of extensive research around that, and we have launched our shift strategy. And that shift strategy, 2/3 in manufacturing, 1/3 in technology. In hindsight, in fact, we ourselves have not expected the kind of return with this shift strategy as generator for the investors. Rupees 1 crore invested in October 2020 is worth 4.8 crores now post our fee and expenses. So this is the kind of opportunity which volatility throws on you. So this is also a year when there will be a plethora of opportunities. Whenever there will be volatile time, there will be. And now let me just quickly touch upon few of the structural things which are going to help investors who are investing in India. See, if I look at India, manufacturing story is still intact. India as an economy, or Indian companies offer highest ROEs in the world. India as a leverage is one of the least leveraged country in the world. In terms of fiscal discipline, even in the recent budget, finance minister have added to fiscal discipline, despite of throwing 1 lakh crores of additional money in the hand of taxpayers, while keeping her capex spend intact. Even after that, if a country like India can manage with 4.4% kind of fiscal deficit, your banking GNPA are all-time high. Like, I was just seeing data, a few years back, our GNPA of banking system used to be 9-10%. It means if you lend 100 rupees, 10% of that goes NPA. And banks operate almost at a 10-time leverage. So if banks are running at a 10% GNPA, it means their entire equity capital or shareholders' capital has gone for a toss. That GNPA is right now at around 2.4, 2.5%. thanks to our bankruptcy reforms and whatever reforms which has happened in the country. So bank balance sheet is robust. Corporate debt to GDP is at 56%. Household debt is controlled. So, and government borrowing is also controlled. So all four balance sheet are perfectly in order. And on top of it, the kind of reforms which has happened, like India's manufacturing GDP, just $450 billion, which is 15% of GDP. There is a target to take this number to 25% of GDP, which means this $450 billion will go to around 1 to 1.25 trillion dollar. If entire manufacturing space is going to double or triple in next 6-7 years, it is going to create huge opportunities for various sectors, subsector. Now let me quickly jump to a few of the sectors where we are bullish on, and then I will hand it over to Sachin. So few of the sectors which we think there will be a good amount of opportunity in the current year. Within manufacturing, we are very bullish on CDMO. We are bullish on chemicals, pharma, auto ancillaries, select discretionary consumer durables, and we are also very bullish on banking and financials. I think that is also going to really do very well. Your loan growth is intact, and with interest rate reduction has started, I think only pressure with the banks were having is on account of NIMS margin pressure. With reduction in interest rate, initially it will be bad for NIMS, but over a period of time, it will help them to garner higher deposits. So the ROAs and ROEs will also come back along with the growth, and asset quality issue, I think, has been addressed structurally in the country. So these are the few sectors where we are bullish on. So with this, I conclude my opening remarks, and over to you, Sachin.
Yeah, thank you. Thank you, Anand. Thank you, everyone. It's a full house. Very nice to be here. I think one good thing that if I have to talk after Manoj is that I don't have to talk much. He's practically covered everything, and I fully agree with everything that he has said. Nevertheless, I think the point that he made about, in terms of the wealth creation, so I think that's a very, very valid point, that we all have to be very clear that are we here for a 2020 match? Are we here for a one-day match? Are we here for a 5-day match? So basically the point is that do we want sustainable wealth creation, right? That is something is, very, very easy, but also very difficult. And when I say very easy, it's just a function of using common sense. I tell this to a lot of people. When it comes to investing, it's just about using your common sense. But yet, when after the end of the bull market, and when the next bull market also starts, we have seen, at least in my 25 years of my journey, I have seen, the investors that have sustained to the next bull run are very few. The reason is, in the earlier bull market, most of the people died in the sense in terms of their investment journey, because of only one thing, and that is greed. Greed, and greed. And that overrides the common sense of most of the people. And which is what Manoj was also referring to, that research takes a back seat during the bull market, and it is only the stock prices, what people are looking at, which drives them into greed. I mean, if you would have told anybody to buy an HDFC bank in the last 2 years, he would have said, you are a fool, you can't buy an HDFC bank. Although it may be the strongest franchisee, Anand is a veteran banking and financial sector analyst, so he will vouch for whether it's HDFC Bank or ICICI Bank. But most of the investors that come to him would have told, asked that, give me a small bank that I can invest in, give me a small NBFC that I can invest in, which will, so even if I will tell somebody here, say, if I tell buy HDFC Bank, and on the other side, if I say buy Nectar Life Sciences, I can bet that 8 out of 10 people will buy Nectar, only 2 will probably buy HDFC Bank. So that's the common sense that most of the people, put it on the back seat. Coming to the overall outlook, I think the market always climbs the wall of the worry. It's always a glass half empty, half full. There are every periods where we have had challenges, and in spite of that, over the last so many years, equities have delivered returns because it is a risk asset. And risk assets will generally deliver decent returns as long as you have done your research right, as Manoj mentioned. And when it comes to the manufacturing sector, so I completely agree with Manoj. In fact, almost now 15 months back or so, even CRISIL came out with a report saying that the manufacturing GDP of this country will grow much faster than the overall GDP of this country. And there are at least these 7 or 8 industries, which is the CRAMS and the CDMO space, the contract research and manufacturing, in the pharma, in the specialty chemicals, auto ancillary, electronics manufacturing, textiles, engineering, hardcore engineering, power equipment. So these are the 7 or 8 industries where Indian companies have actually established the right to win. They have demonstrated to their global customers that they have the domain expertise, they have the scale and size to deliver to the global demand, and they also respect the intellectual property rights at least much better than their counterparts in China. So today, when we talk to some of our portfolio companies in each of these industries, we clearly get a sense that the order books are not only full, but they are continuously rising from the global customers. And a lot of these order books, what used to be a potential a few years back, have now actually got converted into a reality. And all these order books will get executed in the next 2, 3, 4 years. The PLI scheme that the government of India, see, actually this China Plus One has been an opportunity for the last 10, 15 years. But to be very frank and honest, India has missed this bus at least twice to countries like Indonesia, Vietnam, Bangladesh. But in the last 5 years, at least, or last 6 years, the government of India has been very cognizant of the fact that we need to seize this opportunity and not miss the bus. So even before COVID came up, if some of you would remember, sometime in the second half of 2019, and this was not during the budget, this was outside the budget, middle of the year, they came out with a policy where they said that the new manufacturing units will have lower income tax rate of only 15%. So that was first catalyst. Then we came up with a PLI scheme, and PLI scheme is probably one of the very few schemes that I have seen where it's a government scheme but very highly reciprocated by the industry. There is a significant amount of investment that has already happened, and obviously the revenues will now start flowing in the next 2-3 years. I think already 2.4 lakh crore worth of investment is already done, and of course a multiplier of that will continue to play. So I think the outlook is a function of, Anand, to coming to your specific question, it is, are you a long-term investor or are you a momentum investor, right? And as Manoj mentioned, for long-term investors, volatility is a friend. You have to, it is this volatility where you actually capitalize, because, in investing, there are 2 very important things that we all have to understand. It's first and foremost, you can't compromise that. You have to buy a good quality business. When you say good quality business, it includes a good quality management and the inherent strength of the business. But second, and which is also more important, and which is where this volatility comes into play, you have to buy at a very good, reasonable price. Purchase price is also very important. I'll give you a classic example. If you go back to the year 2000 and 2001, Infosys did a profit of just about 300 crores. Okay? In 2015 or 2016, for the next 15 years, Infosys profit grew 50x. It was 15,000 crore of profit. Less than 5 companies probably in that year, or maybe less than 10 companies which made 10,000 crore profit in this country. Infosys was among the top 5 or top 6. The profit grew 50x, 50, in this 15 years. But the stock price in that 15 years for the Infosys shareholders was probably less than the bank fixed deposit rate. The reason is, in 2000 and 2001, the heydays of the IT and the Ketan Parekh boom, Infosys was trading at 150 to 200x. So what is built in the price and what is not built in the price is something what one has to be very sure about. And that is where, what again Manoj was talking about, the volatility creates those purchase prices for good quality businesses. And during these times, it's a great time to actually do a portfolio construct.
Yep. Thank you, Manoj Bhai and Sachin Bhai. The question which remains still pertinent is that are we still in a long-term bull market, and that's the reason the investors should not panic, because that's what is happening right now, and particularly with Trump doing the tricks every day.
I think I have no doubt in that India, the kind of situation at which India is right now, we have not seen India in such a situation ever. In fact, I think first golden moment happened for India's economy was in 1991, when India's economy was decontrolled, or deregulation did happen, license Raj has gone out and all that. And after that, if I see the series of reforms which has happened in this country over last 10, 12 years, like even on the digital side, where we see that Western world is more advanced, but none of the Western world is having a system like UPI in India. We can seamlessly transfer 1 rupee from one pocket to another seamlessly. In fact, there was a delegation which has been sent by Australia to India to study that how you guys have executed this UPI, which is like Digi Yatra, UPI, Aadhaar, each and every citizen has got its identity. Then India, on its own, in fact, gone back are the days when India was dependent on the Western world. India was the country which has created its own COVID vaccine. And in fact, that COVID vaccine still has got no incidence of side effects till now, like Covaxin and the vaccine which got developed completely by India. So, and even India's space mission, India has done at a fraction of the cost without taking Western help. So over a period of time, India has established its global recognition. That is one. Digital side, we are no way inferior. Now let me share few data points. Any idea what should be I can see many young people here. So any idea what should be the average age of population of India? Sorry? 34. It's 28 years. China is 38 years. Western world is even much older. There, one person he has to work for at least another person who is retired. India, it is completely different. 25% of the incremental working population of the world will be from India. That is number 2. Because of, I think, few of the things which Sachin has also mentioned, manufacturing, Indian government has done number of policy reform, have PLI incentives, have reduced the taxation for the new manufacturing units to 15%. All that things put together, every MNC in the world is eyeing India as a manufacturing destination. Last two years back, we were almost zero in terms of smartphones exports from the country. Today, we have started almost touching the leaders there. We are having a significant Apple phone exports and all from the country. So that is also, I think, yeah, sorry? Oh, okay. So I think that is another big thing. So manufacturing is going to be a decadal play. Anybody, if he wants to invest for a year or so, I don't think that he should venture out at this point of time, where there will be a lot of uncertainty. I think certain times are good for traders, for tips and all, but these are not the times. If anybody wants to invest for 3, 5, 7 years kind of horizon, I think it is a very sweet time to invest, whether it is manufacturing, whether it is BFSI, whether it is CDMO, chemicals, all those sectors. And when entire economy is going to do well, these sectors are likely to do well. Let me also share one data. India's corporate profit to GDP is almost at a 15-year high. It is almost, I think, at 5.6% right now. Earlier high was 15 years back. And quite often people compare, are we going to again end up in a 2008 kind of situation? But I think these two things are completely different. 2008, Indian corporates were highly leveraged. There were even Tata Group, Birla Group, everybody has made some overseas acquisition. Birla has made Novelis, Tata has made Chorus, and Tata Motors have made acquisition of JLR, and all those has been funded by a dollar debt from Indian banks. So corporates were leveraged. Secondly, even Indian banks were leveraged, and thereafter Indian bank GNPA was at its high. Hardly India had any forex reserves. Today, if I see the situation, leverage is not there. Companies are comfortably making almost 15%, 16% plus ROEs. And if you can select a portfolio of 25, 30 stocks, you can comfortably create a portfolio of the companies which are generating almost 20, 22% ROE. And generally, these ROEs gets translated into your wealth creation. And if you can compound your wealth at 20, 22%, 10, 15 years down the line, you will see the magic and you can comfortably retire. In fact, let me pause and ask a question. If you have to invest, let's say 10 crores today, and let it compound at 18% CAGR, not even 22% CAGR, at 18% CAGR during Amritkal period, when India's GDP per capita income will move up significantly. Any guesses how much money you are going to make in next 22 years of Amritkal period? 32 times. Okay. Any other guesses? More than 10x. Okay. Any other guesses? The amount comes to 450 crores. 10 crores worth of money compounding just 18% CAGR for next 22 years. And this 18% compounding is good for 1-2 years, but compounding it for 22 years, definitely it requires consistent research, consistent tracking of the companies, consistent tracking of the industry parameters, management, health of balance sheet. All those things I think you need to consistently track, and you have to ensure that your money is getting compounded at least 18% per CAGR to do this magic for you. So this is, I think, one of the things. Now let me just conclude it by sharing some of the data points which I think our Prime Minister has put in his Amritkal vision. So India's GDP right now, which is close to 3.5 to 4 trillion. India's share in world GDP is hardly 4.5%. India used to have almost 16% kind of share in world GDP in the year before British Raj. I think it was in 1750, 1770, when we used to call India as a Sone ki Chidiya. It used to have almost 16% kind of share in the global world GDP, which has come down pathetically to 4-5%. And even after almost 75 years of our independence, the India's share in global GDP has remained there. Now, the pace at which India is growing and the pace at which world is growing, India's share in the world GDP will go up 4x from 4% to 16% during Amritkal period. That is the prediction even IMF and World Bank are having for India. So only thing is, if this growth momentum is maintained and the young population of this country, which is going to do wonders, if they are going to deliver, I think this is the thing which we are going to see. And whenever this has happened, it creates plethora of wealth creation opportunity. I think if you look at South Korea, China, US, in the past when they have moved from developing nation to developed nation, similar kind of thing has happened. So I would say it's a golden period for long-term investors. One need to invest after doing a complete research of the company, balance sheet management, and then monitor that portfolio very closely to create magic of compounding. With this, I think I would conclude and hand it over to Sachin. Thank you.
Thank you, Manoj bhai. Sachin bhai, before you speak, I'll add the question also so that basically you respond elaborately on that. Is that the India story obviously is going well. You said that the corporate earnings are very good, but now the corporate earnings are faltering. They have started faltering for past 2 quarters. And where we go from here, whether the India story altogether, the growth story, the earnings growth story is altogether faltering, number one. Secondly is the FIS. So we have domestic investors growing very strong. On the other hand, basically FII investors have been relentlessly selling, and they are selling large caps. Now, whatever stories that we talked about, manufacturing and all, a lot of large caps are there into that. So how do you see the large caps versus small caps and the mid caps performing in CY 2025? Because FIs will keep selling, large caps will still contract. And most of the people would recommend to go for large caps, particularly when the market volatility is very high. Some people will recommend small cap and mid caps. In fact, the presentations which we are going to see in this day, in the next sessions also, a lot of small and mid caps. So let's try and make their life tougher.
Sure.
So over to you, Sachin.
Sure. Thanks, Anand. So I was going to refer to some of that. So firstly, just to highlight what Manoj mentioned in terms of the UPI and the seamless, I completely agree. It is one of the best things that this country has got. But I'll just add one more thing. It is free of cost. Today, transferring money from one bank account to another, one person to another, free of cost, this doesn't exist anywhere in the world, I can promise you. Transferring money in less than 5 seconds to less than 1 hour and 2 hours, crores of rupees, billions of rupees, it is not possible anywhere in the world. We run an offshore fund, and I can tell you the kind of the challenges that we have. I'll just give you an example. We have an offshore fund in Mauritius, and we have an investor transferred $500,000 in State Bank of Mauritius. State Bank of Mauritius is the State Bank of India of Mauritius, so it is their state, the country bank. From State Bank of Mauritius, the money had to come to Kotak Bank in India. It took more than 3 days. And and they charged, it was $500,000, and they charged us nothing less than $120 just for that transaction. And because then it took 3 days, I deep dived into it, that what is happening. And then I was told that State Bank of Mauritius did not transfer directly money to to Kotak Bank in India. They transferred the money via Citibank. So there was 2 charges between the 2 banks, and then it came to Kotak Bank, and then it took 3 or 4 days. I said, why? Because they don't have a direct line and something. So I'm saying globally, banking is not as much evolved as it is in India. So completely agree with what Manoj said. This is first-hand experience. On the outlook, on the long-term story, I mean, we have seen India has always been a 2-step forward and a 1-step backward. But over a period of time, we always grow. There is no doubt about it. And yet, we have seen enough amount of bulls and bear markets. There are times when markets have given very bad returns. My sense is the calendar year 23, at least the second half, and the calendar year 24 was clearly an euphoria kind of a scenario, particularly for the mid cap and the small caps. Clearly, all the valuations just went through the roof. And even if companies are good, even companies are performing and taking the same example, a best company in this country, one of the best, if I can say, Infosys did this kind of, fantastic performance, yet the returns were very mediocre. So the important thing is at what purchase price you are entering. And I think, there was in terms of the flows, in terms of the narrative, in terms of some of the earnings growth coming because of the low base of the COVID. All of that is probably behind us at this point in time. So I'm clearly of the camp that the mid cap and the small caps will probably take a backseat purely from a valuation perspective, and large caps will probably give a little better return over the next few quarters. And I will address the point of FIIs also on my thoughts on that. But more important here is that please understand that mid caps and small caps is always a bottoms up story, right? So if you own businesses where you believe that these businesses will grow over the next 3, 5, 7 years. And again, coming to that classic point of research, which Manoj mentioned. So, like for example, generally, I don't like to mention the company names, but this is one company where we've been owning it for 15 years. And this is a small cap company. Some of you may know this company called Nesco, which is the Bombay Exhibition Center in Mumbai. And this company has had enough ups and downs. Enough, there was a point where they couldn't build their IT park. There was a time when COVID happened and the exhibition center was not working for 2 years. The 150 crore annual revenue went zero for full 2 years. They lost 300 crores of annual revenue because their entire exhibition center was taken away by BMC as a COVID center. Then there was work from home worry that people will not go to offices and all of that during COVID. So in spite of all these challenges, the company today makes 400, 500 crores of profit. 15 years back, it was making only 50 crores of profit. Today, they have nearly 600, 700 crores of rental income. After paying full tax, they make 400 crores of profit. They have more than 1700 crores of cash on the balance sheet. It is zero debt company. So what I'm trying to say is that for mid cap and small cap investing, you need to really have a little longer horizon. And you need to be very sure that the businesses that you're investing are the management quality is of top class, the management integrity is of absolutely unquestionable. That is something that you need to be very, very sure about. But broadly speaking, I think at this point in time, the valuation comfort very clearly is more in the large caps. And then coming to your point on the FII investing, right? See, let's think about it a little more. See, if you say the calendar year 24, April to September, the first 9 months, FIIs invested nearly 2 lakh crores. October to December, they sold nearly 1,40,000 crores. January, they have sold another 80,000 crores. Effectively, from 1st Jan 2024 to 31st Jan 2025, the 13 months, FIIs are zero investing, right? So they are out of the market. In this same period, the DIIs, the domestic institutional investors, which is your domestic mutual funds and your insurance companies and maybe some pension funds and those kind of things, have invested nearly 6 lakh to 7 lakh crores. Now, in my last 25 years of history, I've never seen this kind of numbers. FIIs were always highly dominating. And so there's a paradigm shift. There's a culture change, right? So we need not to be, we don't have to be so much worried about the FII flows. But I personally believe that FIIs will come back and they'll come back with a big bang. And the reason why I see this is, because we have an offshore fund and when we go to meet a lot of foreign investors, whatever India story and all of that, one big worry that they always have is the currency risk. Because whatever returns that we make in rupee, we are talking about 15%, 18%, but the rupee depreciation eats away nothing less than 5% every year. So that brings down their returns to anywhere between 12, 13%, right? And they are always worried, can this go even worse, right? So one worry every foreign investor will have is about the currency risk. Now think about it this way. If you see before 2014, rupee depreciation practically annually was 5% per annum. From 2014 till 2024, that number has reduced from 5% to just about 3.5%. In calendar year 24, rupee depreciated by only 2.8%. In the last 1.5 months or so, we've seen another 2% of depreciation, but we all know that's Again, to do with the dollar strength versus all the currencies, and all the other currencies have faltered much more than the rupee. Why is this rupee depreciation slowed down so much compared to a decade back? The 10-year US Treasury yields and the 10-year India GSEC, Anand, I'm sure you know this better than me, but just for the interest of everyone, the difference between these two was always 500 bips, at least 450 to 500 bips. This, as on today, has narrowed to less than probably 225 bips. This is the reason why the rupee depreciation generally, and these are 10-year bonds that we are talking about. We are not talking about a 3-month and a 6-month bond. We are talking about 10-year US Treasury. We are talking about 10-year India GSEC. The difference between the two has narrowed to as low as now under 200 to 200, between 200 to 250 bips on a sustainable number. So my sense is once Mr. Trump cools off, once the overall global situation is little better, I think tremendous amount of global money will come to India. Because today, like again what Manoj said, India has become the fastest growing GDP in the world. This is probably for the first time that our GDP growth will be faster than China. So, the money always chases growth. Global investors are always chasing growth. And if you give them stable currency, generally they will come back, is my sense. So I'm not overly worried on that.
Yeah, thank you, Sachin bhai. In the interest of time, what we will do is now we will start with the Q&A from the audience. And there I would request also to address about the sectors that you would bet on in 2025, both of you. So what I'll basically do is open up the floor for Q&A. I'll ask volunteers to basically take the mics to the audience and allow them to ask a question. So if anyone has a question, please raise your hand and then ask a question. So any audience?
For your time and commitment and the dedication towards our community here. My question is, as you mentioned, if you follow those 20-25 companies and do the good research, you can get around 18% CAGR, right? If one does not have that much time to do the research and just follow the Sensex 30 or Nifty 50, will they be able to achieve this CAGR, not 18, but at least around 14-15% blindly, or do they still need to spend that time? And what would be the strategy for that?
Yeah, sorry. So I generally follow a thumb rule that equities as an asset class, and this applies globally, okay, in whichever country that you invest in, you just see what is the risk-free rate, right? So today the risk-free rate in India is say about 7%. You look at the bank FD rate, or if you look at the 10-year GSEC, somewhere in the range of 7% plus minus. So equities as a thumb rule will typically give you returns anywhere between 1.5 to 2.5x, right? That's the range. So 1.5 is the minimum, which is the Nifty return, the Sensex return. So that return will be in the range of anywhere between 11 to 12%, is a fair assumption, is a fair expectation, right? Now, if you do a little better, you might get 13-14%. If the Amrutkal actually plays out, maybe it will be 2 times, it may be 14%. If you will invest in the mid cap and small caps, and if your research is absolutely right, then you will probably make 2.5 times, maybe 18%. So that's the strata that you have to work around with. So passive funds will typically make anywhere between 1.5 to 2x depending on the environment. At least they should make 11 to 12% is a fair expectation. If the environment gets better, like in the last 12 years also Nifty has given more or less about 14-15% kind of a compounded return. But that's a function of in which period we are talking, because the last 3 years have been so good that 14-15 looks good. If you would have asked me the same question 3 years back, this number was probably 12-13%. But it generally gives you 1.5 to 2x in that range as far as the Nifty or Sensex is concerned, is my basic sense.
I think I agree with Sachin, but only one thing: why to settle for less when you can have more? See, I am Marwadi, chartered accountant. So if we can get more, why to settle? If you are in a country like India, where there is an unprecedented opportunity, where there will be at least, I would say, out of 5,000 companies, you can have at least, I would say, 300 to 500 investable companies. Out of those 300 to 500 investable companies, there are, means if you can choose those 25, 30, 40 companies or 50 companies which can do this magic. And in fact, thumb rule is very simple. If companies are generating more than 20% ROEs, and if they are able to redeploy that profit back into the business and grow that money also at the rate of 20%, the magic is done. There is no reason why this ROEs won't flow to you. So without being in the business, you can step into the shoes of a businessman and generate this 20-22% ROE. So that's why I hate investing in FDs. I hate investing because I think if you invest in FDs, actually you are losing money. This country's actual inflation is not the inflation which is published. For guys like us, inflation number is at least double-digit inflation, even if you see your household expenses and all. So first you have to beat that inflation. So if you are making only 10, 11, 12% kind of returns, you are just sustaining your purchasing power. You are not doing anything, or you are not growing your money. So if you really need to grow your money, I think you need to invest either, if you can't do research, delegate it to the professional fund managers, mutual fund, PMS houses, AIFs, who can do this work for you. If you can devote time and you can devote the research, I would say follow active investing rather than passive investing. In fact, we have done a letter also which is there on our website, active versus passive investing. In fact, the thing which you are talking is a passive investing. Like if I can invest only in index, can I generate similar kind of return, in which we have given lot of data points that why active investing for a long-term investor turns out to be a better tool, much better tool. And just 3-4% of additional compounding for 15-20 years is a big gap. So I would say why to go for less when you can go for more.
No, totally agree with Manoj Bhai, particularly in India. I mean, there is a very good case for active investment rather than passive investment, which happens in the European and the US possibly. But I think in India we need to have more of active investment. And Sachin Bhai and I think Manoj Bhai both can help. They have their own funds where you can invest. Next question we'll take.
Hello.
Yeah,
Manoj Bhai, Sachin Bhai, thank you for an insightful session. You talked about manufacturing sectors, you talked about dollar and India, rupee depreciation, everything. Just wanted to, your view on a real estate sector. Just wanted to understand your views.
Hello. Okay. So, hello. Yeah. So, my personal view, so I am assuming you are asking about real estate stocks, right?
It's the entire sector.
Yeah, but investing in real estate companies, right?
Yeah.
Not buying a real estate.
No.
Okay. So my personal view is that we have seen, I mean, they have actually done well in the last 2, 3, 4 years. But if I take a little longer term, 10 years view, and this is a little crude, very, I would say, not very polished kind of a view. But my personal view here is that real estate companies are very good for the promoters and not so good for the minority shareholders. Because they all act like the landlords. I'll give you a classic example. One of the leaders in the real estate companies in 2009-10, I met the company, the IPO had just come out. I really liked the company. In 2009-10, they had a project, very large project in JVLR. and they actually reduced the prices and sold the whole inventory, right? So I said, this guy understands the rotation, because when we talk about businesses, we talk about the inventory, turnarounds and those kind of things. So, this is the biggest challenge with most of the real estate companies, because when I met them, I asked him, what are your plans? And he explained that I have so much of land bank and everything, and we can build at least 20 million square feet. I said, fantastic. How much time will you take to liquidate this? So he said, we will liquidate this in next 10 years. I said, fantastic, which means on an average, you will liquidate 2 million square feet. And even if you have to step it up, from here on, you will start doing at least a 1 million square feet, and then gradually you keep on stepping up. In the last 5 years, maybe you will do 3 million, 4 million, but you will take an average of, say, 2 million. For the next 5 years, I tracked his company. Not a single year they sold more than 3 lakh square feet. Not more than 3 lakh square feet. So, they are just always sitting on the land bank. They are waiting for the prices to rise. So the sense of the time value of money is always missing, because they believe this is my land bank, this is my jagir, this is for my family. I mean, this is one of the, I'm not saying all real estate companies are like this, some may be very different, but generally speaking, this is my, my personal experience.
Yeah, well said. So in the interest of time, Manoj bhai, 3 sectors that you will bet on in CY25, and any sectors that you will completely avoid. Just names of the sectors.
I think one of the sector which we would like to bet upon is banking and financials. And within banking and financial, we will choose those banks who have got like MSME lending platform. I think this is one space which is going, whether it is NBFCs and the banks which have got very good risk management practices. I think banking business is a business of risk management, where your real profit comes from the last installment. Like, I think Uday Kotak in one of the session, and in fact that was so, that statement has so much touched me, that banking is a business where out of, if you have to recover 20 installments, first 18 installment is just you are getting back your money. Your profit will come back if you get your 19th and 20th installments back. So I would say that banks which have got good technology, good risk management practices, good culture, those are the banks which needs to bet upon. And in fact, even the largest bank of the country, like one of the questions which came, whether large caps or a small cap, even the largest bank of the country, if I look at from the global context, it is too small. It has got huge opportunity to grow. In fact, in our Amrit Kal fund, when we have done the research, we have said that banking credit, which has grown 23 times in this country over last 22 years, despite of Lehman, despite of this ILFS crisis, despite of, I think, political logjam, all those things have gone wrong, COVID and all. Despite of that, banking credit in this country has grown up almost by 21 to 23 times. In next 22 years, I think I see opportunity that this number can go even 25x from here, and various banks which can, like, which have capability to cater to MSMEs and all, they will do almost 40-45x. Even this particular year, I think even in medium to short term, all things are aligned for banking sector. So banking and financial should do well. CDMO space should do well, especially few of the biologics companies should do really well. You can do your research and find out what are the biologic. There are only a handful biologic companies in India. So those companies should do well. I will refrain naming the companies. And another sector where we would like to bet money is select IT stocks, basically ER&D plays. So these are the few sectors which we think should do well in the current year.
Thank you. Sachin, by your views, very quick.
Yeah, so very similar. Clearly, private sector banking and within that the leaders is something what we are extremely upbeat about. We believe that those franchises will now really rock. Auto sector will also do well. it is India's consumerism, the young aspirational demography that we have. There is no going back over there. I think auto will continue to do extremely well. Pharma, and within pharma, again, the CRAMS and the CDMO space, and some of the specialty, some of the companies which have actually been very successful in global specialty business. I think these are some of the sectors that we are we are very, very positive.
You know, with me on the stage, obviously you can't hate banking. Yeah, on the lighter note, so no audience, in the interest of time, I mean, you can always network with Manoj Bhai and Sachin Bhai. They are going to be around for a while. So what an insightful and engaging discussion that we have had today. I officially bring this panel discussion now to a close and would request Mohan Bhai to come on stage and felicitate our speakers.
Thank you
Mohan
very
Bhai.
much for your patient hearing. Thanks a lot.
Thank you. Thank you, everyone.
Mohan Bhai, yeah, please be on stage.